Greetings all. In this video, we will work through an example for decision analysis. Specifically, we're going to focus on decision tables. I've made this decision because decision tables are typically more intuitive for most folks. That way you can do a quick and dirty model if you need to, or if you want to do a more involved model, the presentation is typically more accessible to a larger variety of audiences. For those of you that are interested in decision trees, they're a little more involved and a little more complicated, but they still are a very well-known and effective tool. We will save any discussion for decision trees for those that are interested in doing a little bit more with decision analysis. And for those folks, if you want to contact me, I'll share some resources for you or with you that you can explore, and we can have a conversation about that. In this video, I don't intend to rehash everything that you can cover yourself in the textbook. Rather, I want to point out some tips and hints and maybe highlight some relationships that will be helpful for you as you're going through the process. A lot of these things are elements that helped me when I was doing this type of work. Once I realized some of these relationships and how these things sort of fit together, it made my life a little bit easier, and I'm hoping that it'll make yours easier as well. So let's jump right in. For the example, we'll look at Golub Transport, and the scenario for this example is this organization has an opportunity to make a purchase of a very special type of robot that does a lot of work that needs to be done for the organization. The choices they have, they can buy the top of the line robot that does everything it needs to do, but it does it quickly and effectively. The alternative choice is that they buy a smaller and slower robot. Now, in this choice, it still has all the capabilities of the first robot, but it's maybe a little slower, not quite as fast and efficient, but still usable. And then finally, we know in decision analysis, it's very important to explore all the alternatives so they can choose not to buy any robot and continue on with operations as they currently exist. Okay. So that's the scenario that we're looking at, right? We can buy the top of the line robot. We can buy the next tier of robot, or we cannot buy any robot at all. The states of nature that they have considered is we can either have a favorable market. We've got a probability of about 60% for that favorable market, or we can have an unfavorable market, and that's a 40% draw. So, right, we've got three alternatives, two states of nature. Very simple example, but this should provide us with enough fodder to make some interesting decisions. Now, if we pull out the information that's given in the scenario and arrange it in a decision analysis table, this is what we would have. We've got our probabilities at the top. We've got our alternatives listed in the rows, and then the states of nature in the columns. Now, one thing that I wanted to mention that's maybe not highlighted enough in the textbook is where these conditional values come from, right? When you are doing this in real life and you're working for an organization, obviously they're not going to hand you a paragraph that has all the data presented for you, and all you have to do is arrange it and do some calculations. It's important to know that part of this process is collecting and collating data in a way that makes it usable. Now, for these conditional values, obviously, these can be some very complex scenarios, and you need to be sure that you're using good data, right? Because of the garbage in, garbage out principle. In order to do that, I would invite you to either remember back to when you had your economics and finance and accounting classes, or if you haven't had those courses yet, be looking forward to some of the material that you'll cover in those classes. You know, a lot of the things that we do with cost accounting, capital budgeting, forecasting, all of those processes and all of those techniques are used in generating these conditional values, right? So obviously you won't be handed the data, but hopefully by the end of your MBA journey, you'll have the skills that you need to process information and put it in a usable form, okay? Now, we typically start out with decision-making under uncertainty, right? And we don't have to use those probabilities that we have for the states of nature. You know, we're going to use that information eventually, but in the simplest terms, we don't have that. Now, one thing that was helpful for me once I realized it was, you know, not every approach in decision-making under uncertainty is a calculation, right? The Maximax and Maxi-Min approaches to decision analysis do not involve calculations. They are simply a systematic way of looking at the data and pulling out figures. Now, the equally likely, the Laplace criterion, the criterion of realism, and the minimax regret decision do involve calculations. But you know, luckily for me, they're not terribly complicated. The Laplace and the criterion of realism are just two types of averages, right? And all of us are fairly comfortable with calculating an average. The minimax regret has an extra step. You know, there is a data transformation there, but still, we're still dealing with basic adding, subtracting, multiplying, and dividing. So, you know, if you're feeling anxious about these approaches, just keep in mind, you know, what we're doing is very simple, right? If you find yourself in a situation where you feel like things are getting overly complicated, take a step back, take a deep breath, and you know, reconfigure. Understand that, you know, we shouldn't be doing any really complicated calculations. Most of these things are straightforward. And as we step through these, you'll see what I mean. So for the first one, again, this is the Maximax criterion doesn't involve a calculation. We're simply going to go through the states of nature. And in that state of nature, we're going to look at the different alternatives. And the idea is, what is the best alternative for each, or what is the best conditional value for each alternative, right? And then we're going to choose the best of the best, right? In this example, based on the data that we have and that we presented in the decision table, obviously we would pick the large robot because the payoff is the highest, right? So no calculation, just a systematic approach to the data where we're picking out the best of the best. Now, the question that I came up with when I first started doing this is, you know, when would I use the Maximax criterion? When would that be the most appropriate approach to making the decision? Well, and I can think of at least a couple of scenarios where that's important. Number one is, okay, if I know that there is a threshold that I have to meet, right? If I have to generate $50,000 in profit in order to keep the doors open and the lights on for my business, then obviously I want to choose the criterion or the alternative that provides for that quantity. And that's one episode where you would use the Maximax, right? If I know I have to make a certain amount of money, and all the alternatives don't reach that threshold, then I'm going to choose the one that does, right? Now you can argue that that's not really a decision and that that's a requirement, but I think that the logic underpinning that makes sense, right? Another thing to consider is for certain situations, you know, we're going to look at multiple states of nature and multiple alternatives. And the idea is, you know, if I feel really comfortable that things are going to go well, right, then obviously I would want to pick the one that provides me the most return. And again, that would be the Maximax situation, okay? I'm sure everybody can think of additional ways that that makes sense, but I just wanted to plant the seed so you can start thinking about, right? I've got all these different techniques and I've got all these different approaches. What would be the optimal situation for me to apply each one? Now in the Maxi-Min, we don't have a calculation again. This time we're assuming that things are not going to go well, right? And the idea is if things go badly, what's the best I can do if things are not going my way? And in this situation, right, for the first two alternatives, I'm losing money, right? There's actually a negative return. The third decision where I'm doing nothing, sounds a little bit counterintuitive, but at least in that situation, I'm not losing money, right? And so for the Maxi-Min, we look at the worst of the possible outcomes and we pick the best one of those, okay? Again, no calculation. We're just scanning the data, making a systematic choice and applying, some basic logic, okay? Keep that in mind, for these first two, it's nothing that we can make a mistake about other than if we don't carefully read the data and consider all the alternatives. Now, when we start looking at Laplace and Hurwitz and some of these other criteria, now we're going to do some calculations. But as I mentioned, these are not terribly complicated calculations. For the equally likely criterion or the Laplace criterion, basically what we're going to do is go through each alternative and just average the conditional values, okay? So we'll look at every value, every state of nature for that particular alternative, and then we'll average it. So in our example, we have two states of nature, so we have two values. We're going to average, and divide by 2. If we had more than that, right, if we had multiple states of nature, maybe we're looking at economic growth and we had states of nature that pertain to 3% growth, 4% growth, 5% growth, up to 10% growth. Obviously, we would have more conditional values and more entries. And so the number that we're dividing by for that average would be higher. But in our simple example, we just have 2. We can do the calculations very simply and very easily. Interestingly, in the example that we're looking at in Golub transport, when we look at the equally likely scenario, 2 of our alternatives actually return the same value, right? If we look at buying a large robot or buying a small robot, we see that the average return would be $5,000. And so that's interesting. In this situation, we could choose either one of those alternatives, and this criterion would support either one of those decisions. In this situation, obviously, I think we're going to have to look at some additional approaches to cutting out the data and see if that gives us any more clarity on what we can choose. But as far as just applying this technique and applying this criterion, very simple. We go through each alternative, we take the average, and it's going to return a value for us, and then we can compare and contrast those values. Now, the criterion of realism, the Hurwitz criterion, is a little bit different, but it's still not a terribly complicated calculation. Instead of a general average across all the alternatives, all the conditional values in the each alternative, in the criterion of realism, we're going to do a weighted average. But in this situation, we don't use all of the values. We just use the best and worst in each row, or the best and worst in each alternative, right? So, for example, if we had a more complicated example, like the one I was talking about, the GDP growth or something like that, we wouldn't calculate and we wouldn't average all of the values, all the conditional values. We just take the best and worst of each row. And we're going to apply the Hurwitz criterion, or the alpha, to determine the ultimate value. So whatever we set our alpha at, that's what we're going to multiply the best. That's what we're going to weight the best value in, and the remainder is what we weight the worst value in, right? So if we look at that first example, and we look at the large robot that we could choose, we knew that the return and the favorable market is 50%, and the return on the unfavorable market is negative 40,000. So what we're going to do is we're going to say what we think is going to happen is that we're fairly confident, we've got a high alpha of 0.7, that the favorable market is going to be the outcome that actually occurs. So based on that, we're going to multiply the best in row, or the best in alternative conditional value, with that 0.7. Now, obviously, our example is pretty simple, so we only have one other value to weight, but that's what we're going to do. We're going to take that remainder of the alpha, the 0.3, and multiply that by the negative 40,000, and then we're going to combine those together, right? And that's the average, the weighted average of that alternative. We do that for each alternative, and you can see the results there. In this example, the purchase of the large robot gives us the highest return, right? It's 23,000 for that weighted average, versus 15,000 for the smaller robot, and $0 for doing nothing, not making that purchase. Now, an interesting exercise for the criterion of realism, and something that will help you understand what the relationship is between some of the other criterion, is to plug in some different numbers for alpha. So just staying with alternative 1, the large robot there at the top, if we thought this was a perfectly optimistic example, we had lots of confidence that things were going to go well, we could set our alpha at 1. And if we set our alpha at 1, we're going to weight the best in row, the $50,000, we're going to multiply that by 1. And then the worst in row, obviously the difference between the best alpha and the worst alpha would be 0. Okay, and so if we did that calculation, we would see that the result is 50,000, right? And that is the same as the Maximax criterion, right? If we have perfect confidence that things are going to go well, and we weight the Hurwitz at a 1, then the result should be the same as the Maximax. Now, if we take the opposite approach and we say we're really pessimistic about what's going to happen, and we weight alpha at 0, right? The best in row in that situation would be multiplied 0 by 0, and the worst in row would be multiplied by 1, right? In that situation, if we took the best of the alternatives, it would be the exact same as the Maximin criterion, right? So, in the absence of actual probabilities associated with the states of nature, we can use the criterion of realism to look at situations in between the maximum and minimum that we have. But to use a check on our work, or to make sure that our logic and our calculations are operating correctly, we can look at different values for Hurwitz and see how that approaches one maximum or minimum. Okay, and so that gives us a little bit more confidence. It gives us a little bit more flexibility in looking at, what if we're not perfectly optimistic, or we're not perfectly pessimistic, but we're looking at something in between. Now, the last of the approaches for decision-making under uncertainty is the minimax regret decision. And ultimately, we can do a couple of things with that. We can calculate an expected opportunity loss, and we can calculate the minimax regret decision, okay? But before we get to that, we have to do a little bit of data manipulation, right? We would start with the original data decision table. But in order to get a minimax regret table, an opportunity loss table, we would take the best return for each state of nature and subtract each conditional value from that value, right? So if we looked at the first state of nature, the favorable market, the best value, the best return in that state of nature from the original table was 50,000. So that's going to be our anchor level. And we're going to take each conditional level or each conditional value and subtract from that 50,000. And the result is what we have there. I'll let you go back and review the numbers from this slide. And you can also look at the Thompson lumber example in the textbook and do some practice with that. But once we've calculated the opportunity loss table, the procedure is very, very similar, right? We're going to choose the alternative that provides the least amount of opportunity loss, right? Opportunity loss is how much money we're leaving on the table, right? And so we don't want to leave money on the table. We want to make a decision where we recoup as much of the financial impact as possible. Now, in this example, the one we're using for this slide, we would see that we've got three values once we do the calculations. We've got 40,000, 20,000, and 50,000. But since we have calculated an opportunity loss table, we want to take the lowest of those values, right? So in this situation, we would choose to build the smaller robot because we're only leaving about $20,000 on the table, okay? That, for a lot of folks, is maybe a less intuitive than some of these other approaches, but with a little practice, you can you'll become accustomed to that, and you'll be able to explain it to somebody in simple terms, right? What we're doing with the Minimax Regret, we're minimizing regret, right? We want to minimize the amount of money we leave on the table, the amount of money that we don't get to recoup, right? And obviously, we want to keep as much money as possible, so we look for the smallest value there, and that would be the Minimax Regret decision. Now, we've talked about the 5 approaches to decision making under uncertainty, but the problem that we are exploring gives us an additional piece of information, and that additional piece of information is the probabilities associated with each state of nature, right? And so when we have that information, the typical quantitative analysis approach is, I want to make decisions based on all the information possible, right? And the more information I have, I want to be able to integrate that into my decision-making process and come out hopefully with a more effective and a more efficient decision. Now, the other thing to keep in mind, we're talking now about decision-making under risk, right? We've got probabilities. We're going to include those in our calculations, and we can hopefully make a better decision. This is the expected monetary value, or the EMV, is the typical economic approach to quantitative decision making, right? When we have a probability, we use it, we make those calculations, okay? When you have this information, when you can either project, forecast, or you have expert opinion that provides you with the probabilities to use, this, based on conventional wisdom, is the most effective approach to making decisions, right? You can go through decision making under uncertainty and pretend like you don't have the probabilities just to see if you can triangulate with those other approaches. But when you have this information available, the typical approach is to calculate the EMV and use that as your primary source of decision making, okay? Once we do that, what you'll see is this is basically a weighted average again, right? We're going to take the best, or the return of conditional value for each state of nature, and we're going to multiply that by the probability of that state of nature and sum across, right? And so each alternative will give us a value, and then what we're going to do when we calculate the expected monetary value is pick the highest of those results. The example here shows you the calculation for our goal of transport example. We take just the first one, the large robot. We know the return's 50,000. We have a probability that state of nature is going to occur at 0.6. We've got our second example where we're going to lose $40,000, but we think that the probability of that state of nature is only 0.4. We multiply through and add, we get 14,000. We do that for each alternative. We see that we get three values. We would choose the one that provides the highest return, which is the large robot, or the alternative one, at $14,000. Okay. If we were given, if we had to do a quick and dirty model, we had to make a decision based on the data that we have, and we wanted to share that with an investor or a board or the other folks working with us. This is probably the approach that you would take. If you have the data, include that information, and then make your choice. Okay. The calculations are not terribly complicated. We're just trying to use as much information as possible. Now, what we'll see here in a minute when we look at the Excel QM software, it's very easy to do this when we have software making calculations for us, but it's good to understand what the underlying logic and what the underlying calculations are for this. Now, one last thing that I want to point out that I think is a really helpful piece of information that you can calculate if you have probabilities on the state of nature is the expected value with perfect information and the expected value of perfect information. Now, when we have probabilities that we can apply to the states of nature, we can do this additional calculation. This is really helpful because a lot of organizations, and there's a lot of resources out there that provide strategic intelligence for a business, right? And the idea is, if I have more information about a market, I can make better decisions. But the question becomes, how much do I want to spend for that? Now, in the absence of a quantitative analysis approach, it's a gut decision, right? How much do I feel like this information is worth? And then, how much can I afford? Things like that. A more systematic and a more mechanical approach to that is to calculate this expected value of perfect information. It's not terribly complicated. It just takes a little bit of additional work. What we'll see here in a minute is most software will calculate it automatically for you anyway if you submit for it. But this is a nice little calculation that will help you make a spending decision, right? I'm already going to be spending a lot of money on whatever alternative I choose in a business decision. How much additional money I pay for additional information is helpful, right? Because obviously I want to minimize the cost of anything that I'm doing, but I also want to make sure that I'm getting good value and a good return on my investment. So what you see in this slide is the actual calculation. For the expected value with perfect information, we're just going to look at the best payoff in each alternative. And we're going to multiply that by the probability of that alternative, right? So it's a weighted average, but we're just looking at the best payoff for each state of nature, okay? And then once we have that, we can sum across all the different states of nature with the best payoff and their probability. What we're going to subtract is the best EMV, right? The best expected monetary value. And so you can see automatically why we can do this with the EMV, with the probabilities associated with the state of nature, because that other calculation that we did earlier is part of this. And so conceptually what we're doing is we're saying, if I had perfect information and I could forecast with certainty what outcomes are going to be there, what is the highest amount of money that I could expect? And you're looking at the difference there, and that's how much you would spend on strategic intelligence or market data or whatever you're attempting to buy, because beyond that, you're actually losing money. You're going to be cutting into your return on investment, and that's important, right? We want We want to maximize our return and recoup as much money as we possibly can. So for our example, we'll look at the expected value with perfect information for the goal of transport example. We're going to look at the expected monetary value for that. Now, if you think back to the table that we had, the highest return in the favorable market is $50,000, and they had a probability of 0.6. The highest return in the unfavorable market is 0, right? The do nothing option, and that's at a 40%, right? So we combine those two with the weighted average, and we get $30,000. We take that $30,000 and we subtract the expected monetary value that we calculated earlier, which is 14. And what that tells us is we should pay no more than $16,000 for strategic intelligence or market data or whatever piece of information we are considering buying. Okay. A nice little calculation, and now a nice little additional piece of information that helps us hopefully save a little bit of money and be good stewards of our resources. All right, so let's take a look at an example in the Excel QM software. So we'll open up Excel QM. We'll enable our macros. All right, now we can get started. We'll go up to our Excel QM tab. We'll go to decision analysis and then decision table. Now, here's our opening screen, right? We have to make some choices here and plug in some information. So we'll name it goal of transport after our example. We'll call our sheet name example 1. Now, remember our alternatives, right? We had to buy a large robot, to buy a smaller robot, and to do nothing. So we had 3 alternatives in this example. Now, the objective here, that is for maximizing or minimizing costs. So in our example, we're maximizing return, right? We're getting the return values that we have for making these purchases. So we're going to push maximize. If we were dealing with cost data and we were looking to minimize costs, obviously we would take the other option. Now in this example, we've got the 2 states of nature. We've got a favorable and unfavorable. I'm just going to leave that as scenario instead of doing additional labeling for that. But if we had more states of nature, maybe if we had favorable, unfavorable, or neutral or something like that, we would up that, put in 3, but for our example, we just got 2. And then the last part of this, we have our additional or optional information. For this, we're going to check both of these. This gives us our EVPI, right, our expected value of perfect information, and it'll calculate the minimax regret, the opportunity loss table for us. And we've got a feature here where we can calculate the Hurwitz criteria. So given this and the other pieces of information that it's going to calculate for us, we should have just about everything we need to make a decision using decision-making under uncertainty and decision-making under risk. We hit OK, and now we've got our input screen. Now remember that for Excel QM, we're only going to plug data into the orange colored cells, and we're going to let the program populate everything in the gray. So what we're going to do is just plug in the information that we have, right? So the probabilities, we'll say scenario 1 is the favorable market, scenario 2 is the unfavorable. So we've got a 0.6 for the favorable, 0.4 for the unfavorable, and now we can start plugging in our conditional values. So the decision 1, that's our large robot. In a favorable market, we'll make 50,000. In an unfavorable market, we'll lose 40,000. For a smaller robot, we'll make 30,000, or we could lose 20,000. And if we do nothing, we neither make money nor lose money. Okay. So we plug that in, and what you can see automatically is it has gone ahead and calculated everything for us. We didn't have to do anything additional. The information can be found here. Our maxi-max criterion is on the far right here. Our maxi-min criterion is in the middle. And then our expected monetary value is on the left, okay? So we've got 2 of the 5 decision-making criteria under uncertainty, and we've got the decision-making under risk calculated in the first box there. We drop down, we've got the expected value of perfect information. If you remember from the example, the expected value with perfect information was 30,000. We can see here that the best expected value is our EMV, and so those two are equal. They're simply going to do a subtraction of those two numbers, and that gives us our expected value of perfect information, right? It was 16,000, which is what we had calculated before. Down below, we've got our opportunity loss table. They have done the calculations for us there. You can see the values where they've subtracted each conditional value from 50,000, and we've got our opportunity loss table. We've got 2 pieces of information down here. We've got our maximum, right, which is our mini-max regret, which is 20,000, which is what we had selected before. And then we've got our expected opportunity loss, which is 16,000. And you'll notice that the text points this out, but the expected opportunity loss and the expected value of perfect information are equal. And you can check your calculations and the functioning of the software by looking to make sure that those 2 values are the same. As long as they are, you have some confidence that things are working the way they should be. Now, our last piece of information will go up here. The Hurwitz alpha, we get to plug that in. The example we use, we said that the alpha was 0.7. We plug that in. It does the calculations for us automatically right below. In this example, we would obviously pick decision 1 that gives us the highest return of 23,000. Very quickly, very easily, and with very little propensity for mistake. Now we can go up here and we can change this, and we could flip-flop it, right? So we can say that right now the Hurwitz alpha is 0.7. So we're fairly confident that it's going to be a favorable market or a favorable outcome. If we change it, we could flip that and say, okay, now we think it's going to be there's a higher chance for it to be an unfavorable market. So we're going to set the alpha at 0.3. We click that in. We go in and make our decision. We can see that the numbers have changed significantly. We've got negative 13,000, negative 5,000, and 0. In that scenario, we would choose 0, right? We take the do nothing because we're losing the least amount of money, right? And a nice little feature here, if you go in and put in 0.5, you can see that it'll calculate the little place, right? It makes everything equally likely. And those values that we had, that we calculated where we saw that alternative 1 and alternative 2 had the same result is right there, okay? Very simple, very easy. You know, when we're stepping through the example in the PowerPoint and we're looking at the different values, it's kind of clunky and it's kind of awkward. But knowing that when we look at the calculation in the software, we can see that things are much simpler and a lot less awkward. All right, everybody, please feel free to experiment with some of this data. Check it out, change the numbers around, look and see what you find, and good luck with the decision analysis.